Hello everyone, this is Sebastian McMahon from IA Financial Group and I'm back with the weekly review, this time for the week ending June 16, 2023. So looking at the markets this week at the close on Thursday, pretty much green everywhere, bonds with lower rates in for the stock market. Again, a strong performance from the Nasdaq. The AI team has been creating some momentum in the markets and now seems to be bleeding over to some other sectors, pushing some investors to join in. To 3% on the week on the Nasdaq, 2% on the S&P 500. It's interesting to see that there's still some momentum also in EFI, or in more precisely in Europe. When you bring everything back in Canadian dollars, you're close to year-to-date returns between the S&P and the EFI index. TSX has been underperforming this year. Of course, it's more about the tech and the growth rather than the cyclicals and the value names. So this is not helping the relative performance of the TSX. But let's see what the second half of this year brings us. Other markets, price of oil higher, Canadian dollar, euro higher versus the US dollar, and the price of gold going nowhere at about $1,960. So this week it was all about the Fed and the US inflation. So let's start with the Fed skipping a meeting for the first time in 15 months. So an interesting development. It was expected by the markets. Mr. Powell is not the greatest communicator that the Fed has seen. Some of the communication was seen as a bit awkward, but the market hears what it wants to hear, and the market focused on the fact that we are in a pause right now. We are getting late in the tightening cycle. We're about to be done here, and few things here. Mr. Powell did remind investors that the July meeting is live, meaning that they haven't made their decision yet. They can decide to hike or not. They are staying hawkish. They are still pointing towards some hike by the end of this year. They are saying that it's time to look at what the data is telling us about the impact of the accumulated tightening of the last 15 months. So multiple things here. Mr. Powell did say something that was peculiar, saying that rate cuts are maybe a couple of years out, which flies in the face of, if I change the slide here, of the dot plot, because the dot plot is pointing towards 2 more hikes this year. Again, this is the median that's there. Every dot here is the positioning or the view or let's say the expectations of one of the FOMC committee members. As you can see on the left, you have one member that sees above 6% rate this year, but let's say the median is at about 560, which would be, now we're at 525, so that means about 2 more hikes by the end of the year. So hawkish message for the short run, but where it's peculiar, the comment by Mr. Powell, is when you look at 2024, well, the committee, the median seems to be pointing towards a few cuts in 2024, likely in the second half of the year, unless we do have a very strong, very significant slowdown of the US economy. Until then, when we look at the consensus of forecasters right now, we do see strong growth in H1. It was a surprise. H2, well, Q3 and Q4, the consensus is pointing towards 2 consecutive negative quarters for GDP growth. Let's see what happens. Is it enough to say that the recession is just on our doorstep? It's not only about GDP, it's also about industrial production, unemployment, disposable income. So there's lots of factors to look at, but we need likely a stronger slowdown than what's currently baked into the consensus forecast to see cuts in early 2024. So Mr. Powell doing his best to sound hawkish. The message was not, let's say, clear, but the markets hear what they want to hear, and the markets are focusing on the positive, which is that we're close to the end or at the end of the hiking cycle. The Fed is getting more hawkish every meeting despite the pause, and that's an important message here. So you have the 2023 dots, 2024 dots, and 2025 dots here. And you have the dates of every meeting here. So the message is that since late 2021, every single meeting that we move forward, the committee is getting more and more hawkish, or seeing more and more hikes or higher and higher rates for the end of each of these 3 years, because it's recognizing that inflation is sticky, recognizing that the job will be hard, rates will not need to stay higher for longer. So the message or the tone or the state of mind of the committee remains hawkish. So it's not a committee that's turning dovish at any time soon. It's a committee that's thinking that, all right, maybe rates are high enough now, but they'll have to stay high for a while. How long? It's hard to tell, but we can infer from their forecasts here on the next slide that higher rates should remain maybe until unemployment goes to 4.5%. At least this is the way that we read this thing here. If you look at the latest forecasts from the Fed, well, Fed has revised its outlook on GDP higher in 2023 to recognize the strength of the first few quarters, but lower in 2024. After that, it is eyeing 4.5% unemployment in 2024 and 2025. This would be a significant rise from the 3.7% level that we have now. So it's not a clear-cut signal. It's not like it's they're flagging something very precise here to the markets. But the way we interpret that is that they think unemployment will go all the way to 4.5% and then start maybe to come back. So maybe this is the trigger. They will keep rates higher until we see the economic impact on the labor market, which tends to come late. This is one of the latest component of the economy to react on to monetary policy. So maybe that's the trigger. Rates higher until we get at 4.5% unemployment, and then some cuts. So maybe that brings us in the late 2024 rather than early 24 for sure. Inflation is also seen as being more resilient this year, and again they upgraded their forecast for inflation by the end of this year. So talking about inflation, here you have two charts here. First, on the left, total inflation falling to 4.1%. That's the easy part. Year over year, we're removing some strong months from early 2022, so getting back to 3%-ish should be easy, but after that, getting back to 2% in a consistent way, that's going to be the challenge. Core inflation is sticky at the 5.3%, so sticky because of services. Remember that core inflation, you remove energy, you remove food, so the impact of oil prices is taken out of the equation. So that brings us to the chart on the right. Goods inflation went up like a rocket and then fell like a rock because of inflation in the price of gasoline in large part. Other components, sure, but gasoline is all over this chart. But the services part of inflation, yes, coming down slightly, but still high at 6.3%. Everything to do with wage pressures. So this is the part that's going to be difficult. Thus, the emphasis on the labor market and the unemployment rate having to rise before they say that, all right, we've done our job as a central bank. So we're not there yet, and there's still lots of progress to be made. Next week, we'll watch retail sales in Canada for April. We'll be looking also at this Bank of Canada's summary of deliberations from the latest decision. In the US, we'll look at housing, so the NAHB Housing Market Index, housing starts, and building permits. Now, maybe a bit of a change here to this slide. Where to find this? ia.ca/economy remains. You will find this weekly review here. It's very retail oriented. You can share that with your clients, or if you're a client yourself, or you're just passionate about the economy, you'll still have the same great content. The podcasts are here. Economy and Finance 101. You can also follow us on social media. But if you are interested by more sophisticated content, well, there's a new page, IA Global Asset Management, so iagam.ca/insights. This is the sub page for where the insights live. So you'll find the macro and strategy monthly, which is something that we've been writing in our team since November of last year. If you're interested by more sophisticated content, it's a great monthly read. And also the insights, we cover some. We present some topical pieces. Last year, we wrote about our view on housing. So if you want topical content, irregular but timely, then you can find it on this webpage, so iagam.ca/insights. So always a pleasure to serve you, and I'll be back again next week.